When you think about precious metals like gold, silver, and platinum, you can't just look at them as shiny pieces of metal or speculative assets. To really grasp their value, you have to look deeper at history, at psychology, and at the mechanics of how economies actually function. For thousands of years, societies have turned to these metals in times of uncertainty, not because they are glamorous, but because they are reliable. When systems break down, when currencies collapse, when governments overpromise and underdeliver, these metals stand outside of that chaos. They are nobody's liability. They aren't a promise written on paper that can be broken. They are real, tangible, scarce, and universally trusted. That is why they are called safe havens. Now, the importance of safe havens becomes crystal clear when you step back and look at what's happening in the global economy today. Debt levels are at record highs. Governments are borrowing at a pace that would have seemed unimaginable a few decades ago. Inflation, while it may cool temporarily, has a way of resurfacing when monetary systems are stretched too far. Central banks can print money, but they cannot print value. And as more money is created to cover obligations, the purchasing power of that money declines. In such an environment, what people crave is something that cannot be diluted, something that holds its worth regardless of political decisions or financial engineering. That's where gold, silver, and platinum enter the picture. Think about gold first. Gold has been money for over 5,000 years, long before paper currencies ever existed. It doesn't corrode, it doesn't rot, and it doesn't disappear. Empires rise and fall, but gold remains. When the Roman Empire expanded, gold was at the center of its economy. When hyperinflation devastated Germany in the 1920s, people turned to gold to protect themselves from wheelbarrows full of worthless currency. Even in the modern world, central banks themselves still hold gold as part of their reserves. If gold were obsolete, why would the very institutions that print money hold it? The answer is simple. Gold is the asset of last resort. Silver has a different dynamic, though it shares some of the same safe haven qualities. It is often referred to as the poor man's gold, but that label doesn't do justice to its importance. Silver is both a monetary and an industrial metal. On one hand, it is a store of value during inflationary times. On the other hand, it is a crucial input in modern technologies. The demand for silver is not only about people seeking safety, but also about industries needing it for solar panels, electronics, and renewable energy. This dual role means that silver has both defensive and offensive qualities. It protects wealth while being tied to future growth trends. That makes it unique among precious metals. Then there is platinum. Platinum doesn't get as much attention as gold or silver, but it should not be ignored. Its rarity makes it inherently valuable. It is indispensable in clean energy technologies, automotive manufacturing, and advanced industrial uses. As the world pushes toward greener energy and sustainable solutions, platinum is going to play an increasingly significant role. Investors who understand this see that platinum is not just a safe haven, but a growth asset in disguise. What ties these metals together is not just their history or industrial uses, it is their role in psychology. Safe havens exist because human beings crave certainty in times of uncertainty. When people feel the ground shaking beneath them, they look for something that won't move. Precious metals have become that anchor. When markets crash, when currencies are debased, when confidence in institutions fades, people instinctively turn to what has worked for centuries. This is not just theory, it is observable reality across every major financial crisis in history. But here's the deeper insight. Safe havens are not just about protection, they are about positioning. If you wait until the crisis is visible to everyone, the opportunity is gone. By the time the masses run to gold, silver, and platinum, the prices will have already surged. The key is to recognize the signals early and prepare. That is why understanding the role of precious metals now before the storm intensifies is critical. Consider what happened during the 2008 financial crisis. Before the collapse of Lehman Brothers, before the headlines screamed panic, there were already signs: ballooning debt, risky lending practices, unsustainable leverage. Those who paid attention and positioned themselves in safe assets were not only protected, but they also grew their wealth when others were devastated. Gold surged as the crisis unfolded, not because it suddenly became valuable, but because people were reminded of its timeless value. The same pattern is playing out again. In 2025, the global financial landscape is entering another period of stress. The World Bank's warning is not just noise, it is part of the signal. It is telling you that cracks are forming in the system, and when the pressure builds, investors will flee toward what feels safe. The question is, will you already be there, or will you be part of the crowd rushing in too late? Safe havens should not be thought of as an afterthought or an optional piece of a portfolio. They are the foundation. When you build a house, you don't start with the paint or the windows, you start with the foundation. Without it, everything else collapses when the storm comes. Gold, silver, and platinum are that foundation. They may not be flashy in good times, but they are the assets that keep you standing when bad times hit. And let's be clear, holding precious metals doesn't mean abandoning other investments. It means balancing your portfolio in a way that respects reality. Stocks can offer growth, bonds can offer income, real estate can offer stability, but all of these are vulnerable to systemic risk. Precious metals are different because they sit outside the system. They are not tied to someone else's promise to pay. They are not tied to a central bank's decision. They exist in their own category, independent, scarce, and enduring. That is why precious metals are more than commodities. They are safe havens. They are signals. They are the financial equivalent of lifeboats on a ship. You hope you never need them, but when the iceberg appears, you will be grateful they are there. Ignoring them is not just risky, it is reckless, because history shows us one undeniable truth. Every system, no matter how powerful, eventually faces stress. And when that stress arrives, those who prepared with safe havens survive, while those who didn't are left exposed. So when you hear about gold, silver, and platinum set to explode, don't think of it as hype. Think of it as a reminder that wealth is not just about making money, but about keeping it. A reminder that storms don't announce themselves politely. They arrive suddenly, and a reminder that the smartest investors are those who build protection before the danger is visible. That is the essence of safe havens, and that is why these metals matter more now than ever before. When you look at the world and the way economies move, it is easy to get caught up in the moment. Headlines, stock prices, interest rate decisions, and political debates all make it seem like everything is unpredictable. But when you step back, when you zoom out beyond the daily noise, you begin to notice something powerful. Everything moves in cycles. Debt, inflation, growth, decline. These are not random events. They are patterns that repeat themselves over and over again. The people who understand these cycles don't get blindsided when things shift, because they see the rhythm. The people who ignore them are the ones who get crushed by the same mistakes that have played out countless times before. Cycles are like the seasons. You don't plant crops in the dead of winter and expect them to flourish. You don't dress in heavy coats during the heat of summer. And yet in the financial world, most people live as if winter will never come. They assume that when times are good, they will always stay good. But history shows us that economies, like nature, move through predictable phases. There is a time for expansion and optimism, but it is always followed by a period of contraction and reckoning. The timing may vary, the triggers may look different, but the cycle itself is inevitable. That is one of the clearest examples. Borrowing can fuel growth in the short term, It allows people, businesses, and governments to spend more than they earn. This creates the illusion of prosperity. But debt is not free, it is simply borrowing from the future. Eventually, the future arrives, and the debt has to be repaid, either through higher taxes, reduced spending, or inflation. When debt piles up too high, it becomes unsustainable. And when the weight of that debt becomes unbearable, economies shift into painful adjustments. This has happened in ancient empires, in modern nations and small economies, and in global superpowers. The faces change, but the pattern doesn't. Inflation follows a similar rhythm. When too much money is created, its value declines. Governments often turn to the printing press in times of stress, trying to ease the pain by creating liquidity. In the short term, this feels good. It boosts markets, it provides relief, it postpones collapse. But over time, the side effect is clear. Money loses purchasing power. People begin to realize that what they earn buys less. Confidence erodes. And once trust in money weakens, the entire foundation of an economy becomes shaky. Again, this is not new. It has happened repeatedly across history, from the fall of Rome, when silver was debased, to the Weimar Republic in the 1920s, to countless examples in emerging markets today. If you don't see these cycles, they feel like shocks. A market crash seems like bad luck. Inflation feels like a sudden surprise. Debt crises look like isolated accidents. But if you do see the cycles, you recognize them as part of the rhythm. They are not random. They are inevitable outcomes of how humans behave and how systems are structured. People get greedy in good times. They borrow too much. They assume the future will look like the past, and then they are caught off guard when the cycle turns. Those who pay attention don't make that mistake. Take a look at the rise and fall of great powers. Every empire, every dominant economy in history has followed a similar path. They rise through productivity, innovation, and discipline. Over time, as wealth grows, they also accumulate debt, inequality, and overconfidence. Eventually, those imbalances weaken the foundation, and decline sets in. The cycle of rise and fall is as old as humanity. It is not a question of if, it is a question of when. Those who fail to see it believe that dominance lasts forever. Those who study cycles know that nothing lasts forever. This is why understanding cycles is so critical for investing. Most investors chase what is working right now. They buy when the market is high, when everyone is optimistic, and they panic sell when the cycle turns down. This is the exact opposite of what works. To succeed, you need to understand where you are in the cycle and position yourself accordingly. If you know that debt is unsustainable, you don't wait until the crisis hits, you prepare ahead of time. If you see inflation building, you don't cling to assets that will be destroyed by it. You move into stores of value. If you recognize the decline of trust in institutions, you don't keep your entire wealth tied to promises that depend on that trust. Understanding cycles is also about humility. It is about recognizing that no matter how advanced our systems become, no matter how modern or sophisticated our tools are, human behavior doesn't change. Greed, fear, confidence, and denial, they play out the same way in every generation. Technology evolves, markets grow, economies expand, but the underlying psychology remains the same. That is why the cycles repeat. That is why ignoring them is so dangerous. The opportunity comes not just from protecting yourself, but from using cycles to your advantage. When everyone else is caught in euphoria, you can see the warning signs and take profits. When everyone else is panicking, you can recognize the value that emerges in the ashes. You stop being reactive and start being strategic. That is the power of understanding cycles. Right now, as we approach 2025, the signals are clear. Debt levels are unsustainable. Inflation is not under control. It is being masked by temporary adjustments. Geopolitical tensions are rising. which always accelerates financial stress. Trust in institutions is weakening. These are not isolated events. They are markers of where we are in the cycle. And if you understand that, you don't get surprised. You get prepared. Preparation means diversifying beyond what has worked in the past decade. It means not assuming that stocks will always rise or that currencies will always hold their value. It means positioning in assets that survive outside the system. Precious metals, tangible resources, diversified holdings across countries and currencies. It means thinking in decades, not just months, because the truth is, cycles will always turn. The question is whether you are ready when they do. The most dangerous thing you can believe is that this time is different. Those four words have destroyed more wealth than any bear market. History shows us it is never different. The players may change, the technologies may evolve, the stories may shift, but the underlying rhythm is the same. Those who deny the cycle are doomed to repeat its lessons the hard way. Those who embrace it are able to adapt and thrive. So don't get lost in the noise of today. Step back, zoom out, look at the bigger picture. See the cycles for what they are. The operating system of economies and markets. They may be painful, they may be inconvenient, but they are real. And the sooner you learn to recognize them, the sooner you gain the power to protect and grow through them. That is why cycles matter. They are not just theory. They are the difference between surviving and thriving, between reacting and preparing, between being at the mercy of events and being in control of your destiny. And right now, as the world faces another turning point, the ability to see those cycles clearly may be the most valuable skill you can have. Most people approach investing in wealth like they approach life. They think in the short term, they want fast results, quick profits, immediate gratification. They look at what's working today and assume that tomorrow will look the same. But the truth is, the world doesn't reward short-term thinking for long. The people who build real wealth, who maintain stability through chaos and come out stronger on the other side, are the ones who play the long game. They understand that success is not measured by how much you gain in a single year, but by how much you preserve and grow over decades. Short-term thinking is seductive. When markets are rising, it feels like you're missing out if you're not fully invested in the hottest assets. When everyone around you is celebrating quick wins, it's hard not to want the same. But what most people forget is that the same forces that create booms also create busts. The euphoria of today often leads to the pain of tomorrow. And if you're not prepared for that shift, if you only think about the next 6 months, you will inevitably give back everything you gained. Long-term thinking requires discipline. It requires you to ignore the noise of the moment and focus on the bigger picture. It means asking not just what will make money now, but what will survive and grow across cycles. It means building a portfolio that can withstand both sunshine and storms. Because storms will come. They always do. No bull market lasts forever and no expansion is infinite. Long-term thinkers understand this. They prepare for the downturns even when the world looks stable, because they know that stability is temporary. Think of wealth like a tree. You can plant seeds and watch them grow, but if you keep ripping them out every time you want to see fast results, you'll never have deep roots or strong branches. Building real wealth is about letting those roots sink in, protecting them during the winters, and allowing time to do its work. The tree doesn't grow overnight. It grows season after season, through droughts and storms until it becomes something unshakable. That's how wealth works when you think long-term. One of the greatest dangers of short-term thinking is that it blinds you to risk. When markets are high, when profits are flowing, risk feels invisible. People convince themselves that it doesn't exist or that somehow they'll be smart enough to get out before the crash comes. History shows that almost no one does. Timing the exact top and bottom is a fool's game. Long-term thinkers don't try to outguess the cycle. Instead, they position themselves so that no matter where the cycle turns, they remain strong. They balance their portfolios. They diversify. They hold assets that survive across different environments. They sacrifice some of the highs so they can avoid the crushing lows. That's not weakness. It's wisdom. The truth is, building wealth is not just about numbers. It's about psychology. The short-term thinker is ruled by emotions. Fear and greed drive their decisions. They panic when prices fall. They get euphoric when prices rise. And in the end, they are always buying high and selling low. The long-term thinker, on the other hand, is ruled by principles. They know where they are in the cycle. They know their goals, and they stick to their strategy, regardless of the noise. They don't let every headline shake their confidence. They stay calm when others lose their heads, because they have prepared for both the ups and the downs. Long-term thinking also forces you to confront reality. It makes you ask hard questions about sustainability. Is the debt level of this country sustainable over the next decade? Is this business model strong enough to survive in different environments? Will this asset still hold value when inflation rises? When currencies weaken, when trust in institutions is challenged? These are not the kinds of questions you ask if you're only thinking about the next quarter's earnings, but they are the questions that matter if you care about protecting and building wealth across generations. This perspective changes the way you see opportunity. For the short-term thinker, opportunity is about chasing the next big thing. For the long-term thinker, opportunity is about positioning in assets that will hold their ground regardless of the cycle. That's why precious metals, real assets, and diversification play such a critical role. They may not give you the thrill of doubling your money overnight, but they give you something far more valuable: resilience. They ensure that when the inevitable downturn comes, you are not wiped out. And when others are forced to sell in desperation, you are positioned to buy at the best prices. That is how fortunes are built, not by chasing fads, but by patiently waiting for cycles to hand you opportunities. The irony is that long-term thinking often looks boring in the short run. It doesn't make headlines. It doesn't excite people at dinner parties. But when you fast forward 10, 20, 30 years, the results are staggering. The short-term thinker might have flashes of brilliance followed by devastating losses. The long-term thinker may not look spectacular at any single moment, but over time, their compounding, their discipline, their consistency make them unstoppable. Wealth built this way doesn't vanish with the next crisis. It endures. To think long-term is to understand that life itself is a series of cycles, and your financial journey must align with that truth. There will be periods of growth and prosperity, and there will be periods of decline and struggle. You cannot control the cycle, but you can control your preparation. You can build a portfolio and a mindset that doesn't break under pressure. You can decide that your goal is not to win the next sprint, but to finish the marathon. The world is heading into a period where short-term thinking will be punished more severely than ever. Debt levels, inflationary pressures, and global instability are creating an environment where sudden shocks are inevitable. Those who are unprepared, those who bet everything on what's hot right now, will be blindsided when the cycle shifts. But those who think long-term, who diversify, who protect their wealth with real assets, will not just survive. They will thrive. The difference between the two mindsets is simple, but profound. Short-term thinkers ask, how can I make the most money today? Long-term thinkers ask, how can I build something that lasts? One is playing checkers, the other is playing chess. One is chasing excitement, the other is building endurance. In the end, it is endurance that wins. So when you hear warnings about the future, when you see signs of instability, don't get caught up in the daily noise. Step back, think bigger, build a strategy that will not just get you through the next 6 months, but through the next decade. Because wealth is not about how fast you can grow in good times. It's about how strong you remain when the storm hits. And storms are coming. The question is whether you will be ready for them. Preparation is the quiet advantage that separates those who thrive in uncertain times from those who collapse under the weight of panic. It doesn't announce itself loudly, it doesn't grab headlines, and it doesn't give the thrill of a sudden windfall. But when the storm comes, and it always does, preparation is the one thing that gives you peace of mind while everyone else is scrambling. Most people confuse luck with preparation. They see someone who seems calm in crisis and assume it's because they're fearless or lucky. The truth is simpler. They prepared when the signals were subtle, long before the rest of the world noticed. The World Bank's warning about what lies ahead isn't meant to create fear. It's meant to signal that the time to prepare is now, not later. The danger of waiting is that when risks finally reveal themselves, it's too late to respond effectively. By then, markets are in chaos, opportunities have vanished, and prices have already adjusted. Preparation gives you the ability to move before the crowd, to act from strength instead of desperation. It's the difference between being reactive and being proactive, between being at the mercy of events and being in control of your destiny. Preparation is not about predicting the exact future. Nobody can tell you precisely when markets will crash, when inflation will spike, or when currencies will falter. But you don't need to know the exact timing. You to know that the risk exists, that cycles turn, that instability is inevitable. And with that knowledge, you prepare not with panic, but with balance. You build your financial life in a way that can handle a range of possible futures. That's what creates confidence. It's not the absence of risk that makes you calm. It's the knowledge that you are ready for it. Consider what happens when crises hit unprepared investors. They are forced into bad decisions because they lack options. They sell at the bottom because they have no cushion. They cling to failing assets because they don't know where else to turn. Fear controls their actions, and fear always drives destruction. The prepared investor is different. They may still feel uncertainty, but they are not paralyzed by it. They have built layers of protection, they have positioned in assets that hold value, and they have the liquidity to act when opportunities present themselves. That is what preparation provides, the ability to make choices when others have none. Preparation is also about humility. It's admitting that you don't know the future with certainty. Arrogance says, I can predict exactly what will happen. Humility says, I don't know exactly what will happen, but I know enough to build a plan that works regardless. That humility leads to diversification, to balance, to a portfolio that doesn't depend on one single outcome. Too many people gamble their entire future on one story, whether it's the endless rise of stocks, the permanence of currencies, or the stability of governments. History shows that none of these are guaranteed. The prepared person doesn't gamble. They spread risk. They hold real assets. They make sure that no single failure can wipe them out. Look at precious metals in this light. Gold, silver, and platinum are not just bets on rising prices. They are forms of preparation. They exist outside of the promises of governments and corporations. They don't depend on a central bank's policy or a company's earnings report. They are stores of value that endure when confidence collapses elsewhere. Owning them is not about chasing returns. It's about ensuring that part of your wealth is shielded from systemic failure. That shield is what creates confidence, because you know that no matter what happens in the paper-based world of finance, you have something tangible, something real, something that history has always honored. Preparation is not just financial, it is psychological. When you prepare, you train your mind to expect challenges instead of being surprised by them. You build the resilience to stay calm when volatility rises, when headlines scream panic, when everyone else is rushing to the exits. That calmness is a weapon. It allows you to think clearly when others are clouded by fear. It allows you to see opportunities that panic blinds others from seeing. And it gives you the ability to act decisively, while others are frozen. It's important to understand that preparation doesn't eliminate pain. When economies contract, when currencies lose value, when markets fall, everyone feels the impact. But preparation turns a devastating blow into a manageable one. It turns survival into stability, and stability into opportunity. While the unprepared are drowning, the prepared are navigating. And once the storm passes, they are the ones in position to build again stronger than before. Preparation also has a compounding effect. The earlier you start, the more powerful it becomes. Just as compounding interest builds wealth over time, compounding preparation builds resilience. Each step you take to diversify, each allocation you make to real assets, each decision to reduce dependence on fragile systems adds another layer of strength. Over time, this doesn't just protect you, it transforms you into someone who welcomes uncertainty because you know that volatility brings opportunity to those who are ready. The challenge is that preparation often feels unnecessary in good times. When markets are rising, when the economy looks strong, when optimism fills the air, preparing for crisis feels like paranoia. People dismiss warnings. They mock caution. They believe that the future will always look like the present. That complacency is what destroys them. By the time they realize preparation was necessary, it's already too late. That is why preparation requires discipline. You have to be willing to do what others won't, to act when others don't, to take the quiet steps that will only show their value later. The World Bank's warning should not be taken as a signal to panic, but as a reminder to prepare. The debt levels, the inflationary pressures, the instability in geopolitics, these are all signs that the cycle is shifting. You don't need to know the exact moment of the storm. You just need to recognize that the conditions for one are forming. And when you see those conditions, the rational response is to strengthen your foundation, hold assets that endure, diversify across systems, build buffers so you are not forced into desperate moves. That is what preparation looks like. In the end, confidence is not about being fearless, it is about being ready. When you are prepared, you don't have to deny reality or hope for luck. You face uncertainty with clarity because you know you've built something that can withstand it. That's the essence of true confidence. It doesn't come from arrogance or ignorance. It comes from preparation. And as the world moves into 2025 and beyond, that preparation may be the single most valuable asset you own.